Welcome to Longview. In our first two episodes, we mapped out how the greenback established its grip over global trade and sovereign reserves. Today we're taking a deep step into a layer of finance that will completely upend how you think about money. If I asked you right now, who actually creates the tens of trillions of dollars sloshing around the global economy every single day? Your immediate answer would probably be, well, obviously, the US Treasury prints the paper cash or the Fed taps a computer keyboard to expand its balance sheet. Except, that's only a tiny piece of the picture. Here's a fact that sounds almost mythic in mainstream finance. The vast majority of dollars in existence today have never once set foot in America. They do not exist as physical paper currency, nor as central bank reserves in Washington. The dollars sitting in your corporate accounts, cross-border loans, and global bond portfolios are primarily digital claims on commercial bank ledgers. And here's the kicker. A massive share of global dollar financing doesn't even happen inside the United States. Financial hubs, from London and Singapore to Hong Kong and the Cayman Islands, serve as the real primary nerve centers for dollar borrowing, credit generation, and offshore debt issuance. So the real question isn't just how many paper dollars did the Fed print? The real question is, how does the rest of the world collectively manufacture, fund, swap, and leverage dollar credit without ever touching a Fed printing press? Physical cash printed in America represents a microscopic drop in the ocean. So who is running the offshore credit machine behind the curtain? Today, we dive into the deepest mechanics of global finance to expose Eurodollars, shadow banking, and the offshore credit pipeline. To understand this offshore machine, we have to trace its history back to the 1950s and an incredible Cold War spy story about Soviet dollar deposits. Back in the height of the Cold War, the Soviet Union was earning staggering amounts of US dollars by exporting crude oil to Western Europe. But Soviet leaders in Moscow were losing sleep over a major structural dilemma. Under standard international banking rules, holding dollar balances ultimately meant keeping those funds on the ledgers of commercial clearing banks in New York. Moscow panicked. What if geopolitical tensions boil over, Washington flips a switch and freezes our funds in New York overnight? We'd be sitting ducks. Converting those dollars into non-convertible currencies wasn't economically viable. So Moscow pulled off an ingenious workaround. They quietly pulled their dollar balances out of New York banks and deposited them directly into British commercial banks in London, such as the Moscow Narodny Bank. By holding dollar-denominated deposits outside U.S. jurisdiction, a new market was born, the Eurodollar market, where euro doesn't mean the euro currency, but simply offshore dollar claims. Soviet fear seeded the market, but U.S. regulation ignited the explosion. In the 1960s, American banks were choked by heavy domestic rules, like strict reserve requirements and Regulation Q, which capped the interest rates U.S. banks could pay on deposits. In London, British authorities took a completely hands-off approach. That's between you and the Americans. London bankers went wild. No Fed reserve requirements, no interest rate caps. That means we can offer higher yields on deposits, narrow our spreads, and lend dollars endlessly across the globe. Now, you might be asking, fine, Cold War history is cool, but how does a single deposited dollar multiply into dozens of wild offshore dollars? This brings us to the core alchemy of commercial banking, credit creation. Let's use a real-world scenario. Suppose you're a Japanese conglomerate buying a fleet of commercial Airbus jets from Europe, and you urgently need $100 million in cash. You walk into a commercial bank in London, say Barclays or HSBC. The bank evaluates your creditworthiness, likes your balance sheet, and approves the loan. How does the bank actually disburse that $100 million to you? Does the bank manager call the Federal Reserve to ship armory trucks filled with cash across the ocean? Does the bank drain its own physical vaults? Not at all. In modern banking, extending a loan is a remarkably simple digital entry. A bank officer sits down at a terminal, opens the balance sheet, and makes two entries. Asset side, loan receivable plus $100 million. Liability side, demand deposit account plus $100 million. Hit enter. Boom. The bank just expanded its balance sheet, simultaneously creating a brand new dollar deposit and a brand new loan asset out of thin air. Eurodollars aren't printed on paper. Whenever global trade demand arises and risk parameters allow, commercial banks expand their balance sheets to materialize new dollar purchasing power. But here's a crucial distinction that most commentators get wrong. Commercial banking is only one part of the machine. Beyond commercial banks lies the massive realm of shadow banking, or non-bank financial intermediation, NBFI. Shadow bankers aren't commercial banks. They are money market funds, hedge funds, asset managers, and specialized financing vehicles. They can't create commercial bank deposits with a keystroke. Instead, they take those existing dollar claims and package, transform, securitize, and fund them through repo markets and complex derivatives. Together, commercial banks and shadow banking networks form the non-stop offshore engine that lubricates 80% of world trade. Now, this brings up a massive real-world problem. What if a bank in Tokyo or Frankfurt has plenty of local currency, yen or euros, but its corporate clients urgently need $100 million in dollar cash today? They don't go knock on the Fed's door. Instead, they tap into the most critical, hidden plumbing in global finance, the foreign exchange, FX, swap market. Here's how it works. The Japanese bank exchanges its excess yen for US dollars at today's spot exchange rate. Simultaneously, it signs a forward contract to reverse the trade at a set future date and rate. In plain English, they exchange yen for dollars today and agree to swap them back later. Economically, this functions like a short-term, collateralized dollar loan. Through FX swaps, financial institutions anywhere on Earth can instantaneously convert local currency strength into immediate dollar liquidity. Under quiet market conditions, this FX plumbing runs silently. But during a crisis, when geopolitical shocks hit, everyone scrambles for the exact same exit. Why? Because in a financial storm, institutions aren't worrying about stock prices. They are asking, do I have enough actual dollar cash to cover my short-term debts tomorrow morning? An institution can hold mountains of yen, euros, or corporate bonds, but non-dollar assets won't settle a dollar debt. Everyone rushes to the FX swap market simultaneously screaming, who has dollar cash? According to data from the Bank for International Settlements, BIS, the total outstanding dollar obligations embedded in off-balance sheet FX swaps, currency swaps, and forwards exceed $80 trillion. This isn't $80 trillion sitting in a vault. It represents an astronomical, short-term dollar debt commitment that global finance must continuously roll over day after day without fail. Because offshore lenders operate without a direct central bank safety net, commercial banks don't lend billions on handshakes. They demand premier, bulletproof collateral. This brings us to the ultimate bedrock mechanism of the dollar system, the repurchase agreement, repo, market, and rehypothecation. In a standard repo trade, Bank A needs $100 million in overnight cash. Bank B agrees to lend the cash but demands collateral. Bank A hands over $100 million worth of US Treasury bonds. Hold these treasuries overnight. Tomorrow, I'll repay the cash plus interest and you give my treasuries back. Now, here's where the shadow banking magic happens. Bank B is now holding $100 million in pristine US Treasuries. Bank B also needs cash, so it takes that exact same treasury bond and pledges it to Bank C to raise another loan. This is called rehypothecation, repledging high-quality collateral across multiple transactions to unlock exponential market liquidity. In the offshore world, US Treasuries aren't just passive investments, they are the high-octane fuel powering the entire credit engine. Without treasuries, the offshore dollar machine starves of collateral and seizes up. And this explains why wild swings in treasury yields and falling bond prices are so dangerous to the global economy. When treasury prices drop sharply or market volatility spikes, lenders demand haircuts, requiring more collateral for the same loan. If a portfolio of treasuries that previously secured $100 million in dollar borrowing suddenly only supports $90 million, institutions face instant margin calls. To raise cash, banks unwind leverage, pull back credit, and hoard dollars. If the shock is severe enough, it triggers a cascade across global funding markets, what macro analysts call a dollar crunch. A disruption in US Treasuries isn't just a bond market problem, it threatens the global financial circulatory system. We've now dismantled the inner engine of the global dollar system. Most of the dollars circulating across global markets were never printed on a press in Washington. They were manufactured through commercial balance sheet expansion, funded across borders via FX swaps, and hypercharged through treasury collateral in repo markets. It is a masterpiece of modern financial engineering, astronomically efficient, yet inherently fragile. This completes the structural trilogy of our four-part series. Episode 1, Dollar as the Global Trade Network, Medium of Exchange. Episode 2, Dollar as Sovereign Reserves, Store of Value. Episode 3, Dollar as Offshore Credit and Collateral, Financial Infrastructure, which leaves us with the ultimate questions for our season finale. Is this sprawling monetary empire truly invincible? What happened to the historic contenders who tried to dethrone it? And who ultimately pays the hidden tax for this superpower privilege? Join us for our grand finale, Episode 4, The End Game. Challengers, seigniorage, and your wallet. This channel does not offer investment advice. We aim to polish the precise lens for observing a world in structural transition. This is Money and Macroeconomics. If you found this deep dive valuable, hit like, subscribe, and stay rational. See you in episode 3.